Filming in the money, take one.
Oh, that's so official. Hi, I'm Amber Kanwar, host of a brand new investing podcast called In the Money.
Keep going.
I don't know what to say. There's no teleprompter. Hi, my name is In the Money. Oh, fuck. Are we allowed to swear?
We better not.
My name's Amber Kanwar, and I'm the host of a brand new podcast called In the Money. Every episode, I sit down with a top money manager, we talk about the markets, and I get their best investment ideas. And we're going to take audience questions too. New episodes come out Tuesdays and Thursdays. I hope you'll catch my brand new podcast. Wait, does that mean there's no hair or makeup? The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Well, here we are, folks. This is the first episode of In the Money with Amber Kanwar, and I'm so grateful to have our first guest, Eric Jackson, president and founder of EMJ Capital. Eric, thanks so much for being with us.
Hey, it's great to be with you, Amber.
And it's so good to have you this week because tech stocks have been under massive pressure, and I know that's the area that you traffic. But before we get into all of that, Just introduce yourself. I've known you for a long time, and I've known you in different stages of your career. You were super active. You were an activist investor at one point in Yahoo. And now you kind of handed things over to this proprietary AI model to make your portfolio decisions. So just talk to us or introduce yourself to the viewers.
Sure. So great to be here. It's been a long and windy road for me in this career. Actually, 20 years ago, I was doing a PhD at Columbia in strategy and management. And part of that focus of that PhD was on corporate governance and the impact of like who's on the top management team, who's on the board of directors, and how that affects company performance. So I was meeting a lot of wonky corporate governance professors, and I remember this guy from the University of Delaware, Charles Elson, at the time saying, "Wow, we don't get many PhD students who are really interested in this, this area," because this was at the time of the .com bubble and everything. And he said, "Did you know there's a type of investing style where corporate governance is really important?" I had no idea. And he's like, "Yeah, it's called activist investing. You might have heard of, Carl Icahn of the world, like taking a more negative view to kind of bashing a company's management team and kind of affect change. There's also a more positive, genteel style." And I said, "Oh, I've never heard of it." So he introduced me to a guy named Ralph Whitworth, who was doing activist investing out of California for a hedge fund called Relational Investors. And I got a chance to meet with him, kind of hear about his take, which was really just like sort of a private equity model on a public company.
Yeah.
So sort of going in, buying up a stake, which for a large tech company might only be a 2 or 3% stake, but that might make you the top single shareholder. And then kind of leveraging that kind of major position to go to management and say, "Hey, we've got some ideas of some, levers you can pull to unlock value at your company. And we can either work together or we can go public and kind of trash you."
But that was kind of trailblazing at the time, right? You're saying you're doing it at the .com bubble. And was the first target Yahoo?
Well, the first target was Yahoo. And what was also kind of unique was that it started in like 2006, so kind of a few years after .com. And that was the time when Facebook was really getting off the ground. YouTube had just kind of, been born and everything. Or had been bought by Google. So there was a lot of attention on Web 2.0, they called it, and social media and social networking and stuff. So I had this, I had met Whitworth. I'd kind of heard about the model. I'd gone off and done management consulting. And I really loved this idea of activist investing. And I thought, I wish I had a $3 billion activist hedge fund to kind of, because I was reading about Yahoo in the paper and they were like melting down about something, even though at that time they were still kind of one of the top leaders in internet. And then I had this idea. I was like, well, what if I tried to leverage some of these social media tools as an individual investor and kind of loop in other frustrated, retail investors, and collectively we could have that $3 billion, stake.
So that's the wild part. You didn't do this as a $3 billion fund manager. You got that support.
Right.
And what did you manage to change?
So we built we ended up pooling. It was like a bunch of Marge from Montana type people who had 50 shares, 100 shares. But then we had a few significant investors. And so collectively we owned something like, half of 1% of Yahoo. And I was living in Naples, Florida at the time. I went to the local Office Depot, which is like Staples. I bought a $15 webcam, stuck it into my ancient, huge laptop computer at the time. And on a Sunday morning, I snuck into our guest bedroom because I was embarrassed, my wife would hear me recording a little video blog on YouTube where I was kind of demanding
Remember
change.
2006, so that's that is embarrassing behavior, right? These days now that kids are on the street, they don't care who sees.
Right. And so I had sort of a manifesto. I put it up on a blog. And actually, I put it in a wiki and I said, hey, I'm doing this sort of Web 2.0 thing. So, join my group. If you want to go to my edit my plan, go to my wiki, edit my plan and all this kind of stuff. And, repost me on and all this kind of stuff. I promoted on Facebook, everything. And that was on a Sunday morning. And by the Thursday, the New York Times had written an article about me because it was sort of a man bites dog type story. And maybe if I'd chosen, to go after, some garbage truck company, nobody would have cared. But because it was Yahoo and it's kind of topical, interesting, tech related, it's sort of, the press coverage ended up being as important as the actual meat of the arguments. So it started this 8-month journey. I met the management team, flew out there a couple of times, went to a shareholders meeting where you sort of did this Gordon Gekko, getting up at the mic. And, I remember CNBC was had, I was tweeting about it, this shareholder meeting, and CNBC covered it in the crawl at the bottom. And it was kind of sort of first of its kind. Didn't really lead to any change. Yahoo's management was very stubborn and they kind of ended up stumbling ahead. And then I came back a few years later and got involved in another Yahoo campaign when Marissa Mayer was the CEO and all this kind of stuff. Anyway, that sort of started me into this whole career. You have to take sort of a more fundamental approach to it. A few years later, I got the chance to start my own tech fund from someone who kind of had met me along the way. And met a lot of great Yahoo people at that time because there was amazing talent within sort of mid management at Yahoo. Because if you were interested in tech coming out of the .com bubble, and you want a lot of people left, all the bankers and consultants moved back to New York from the Valley. So if you really like tech, you either had to latch onto eBay, Yahoo, and that was it. Google was nothing at the time. And there was no startup scene. There was no venture capital supporting, hot new startups that you could go to. So you really had to latch onto an established tech company. So I met some great people who were, would tell me wow, you're totally right. We don't know what we're doing, and actually you said that we should do X and Y, but you really should emphasize, Z and, all this other stuff. So they would give me these tips and we ended up staying in touch. And then those people would go on to become bigwigs at Google or VC firms or start their own companies and stuff. So it's actually been a really neat network. And one of the people, ended up writing me the check to start EMJ Capital a few years ago.
So, I mean, that story is really important because it's sort of an origin story, but it also speaks to you don't mind being the only person doing something. You don't mind being early. And I want to cut to where you are today because you've developed this AI model that unearths a lot of the decisions that you make in the portfolio. Some portfolio managers might be afraid of that because it's well, what am I doing here if I've trained this AI to do that? I mean, why do that? Aren't you really just kind of coding yourself into irrelevance?
You can look at it that way, but my view is that AI is going to become increasingly important in portfolio management. And you can sort of rail against that and scream into the, wind, or you can try to be on the leading edge of that, that trend and kind of manipulate it and use it to your own advantage in some way.
So when we talk about the markets today and we take viewer questions, whose answers are we getting? Are we getting the AI model? Or are we also getting how much time are you spending still doing homework the way that you used to?
I find that's my upbringing. Like, so it's hard to let go of that. And to be frank, like we're not there yet where you can just sort of like type into Chat GPT, like, what do you think of the job that CEO, Carrie Wheeler is doing, leading Opendoor and all this kind of stuff. Like we're just not at that level today. And so I think AI is improving every day, but to make the most of it, I think you've got to still have a foot in both worlds of kind of the fundamental analysis, supplemented with whatever, insights you can get out of the AI.
So let's talk about the markets right now. Tech is under big pressure, and we're going to get into it. We're going to get into AI, crypto, quantum. Don't worry, it's coming. But let's just talk big picture tech right now.
Right.
The big fear is interest rates are going up, and that makes a difficult environment for tech investing. And the fear is that, if the Federal Reserve does not cut interest rates, we could be in for maybe a 2022 style underperformance of the tech sector. How are you thinking about the current, let's call it tantrum, that's taking place in the markets right now?
Well, a couple of things. First, I'd say people overreact a lot. And so we are living through a 2-week tantrum right now, but that could be much different, another 2 weeks from now by the end of this month.
Broadly, is it a buying opportunity?
I think so still. I am more bullish than bearish. But full disclosure, I tend to be like a more bullish guy in general, and that's probably a weakness of mine. So I got to check myself on my bullishness in general. But I don't think it's time to head for the exits yet. I remember there was this one time in 2009, 2010 where I was over in China. Actually, I was like traveling around with a friend of mine. We were visiting different Chinese companies, and we ended up in Beijing. And I knew the woman who's at the time she was the head, sort of the top editor of the Wall Street Journal China. And she said, hey, we want you to come in and give a talk to, all our reporters here in Beijing and just sort of give your insights into tech. And I said, sure, great. And what do they want to hear about? And she said, she came back to me a few days later and she said, they really want to hear about why this bubble is about to collapse. This is 2010. Okay. So we're like not even probably 18 months removed from, the full meltdown and the global financial crisis and all this. And so I think as a society, we've been sort of programmed to, maybe it's because of Twitter, X, whatever, like everyone wants to be the first to kind of plant their flag and say, I called it, when the bubble popped in January of 2025, I told you so, and all this kind of stuff. And so everyone's always looking to kind of, say, this is it, and the reality is like bubbles can sometimes just take a long time to develop. I don't think bubble is a bad word, as a swear word or anything. The dot-com bubble went from like 95 with the Netscape IPO until like, June 2020 or 2000. And so, and you had the Asian flu crisis and right in the middle of that, and then just sort of rebounded and kept going.
The data supports you too, right? It's time in the markets, not timing the markets.
Right.
But in the meantime, you have to be prepared to deal with a lot of volatility,
yeah,
especially in the sectors that you're in. We're going to get into these questions, but before we do that, one of the big topics that's going to come up is quantum computing. And some people might be able to get their heads around AI and maybe cryptocurrency. Quantum, maybe a little bit more of a different beast. Can you just spend a beat on like, what is quantum computing? Why is it so potentially transformational? And then because it's been around, this idea has been around for a while. Why did it all of a sudden rip in the last 2 months?
So we've been living in the era of classical computing up to this point, which were driven by CPUs. And Intel was the major workhorse of that, phenomenon up till now. And then more recently, we've had, Nvidia come up with GPUs. So in the classical computing framework, a computer, and when you program it, you basically have two states, 0 and 1, possible,
yeah,
right? And so the big difference and the power of what Nvidia has sort of come up with as with GPUs is that there was this parallel way of processing data, but still in a 0-1 kind of framework. Mm-hmm. So I'm analyzing a bunch of different data sets. 0-1 this, 0-1 that, 0-1 this, and so forth. But much more powerfully in the GPU world. In quantum, sort of think about that kind of 0-1 world, but then like stack an infinite number of possible states on top of it. And so it's just allows you to take like so many more, it's almost like running an infinite number of scenario planning around different questions that you might have. And it ends up solving certain problems a lot faster.
But I've been talking about quantum computing for a long time. And what are the problems with it? What's stopping it from being mainstream right now?
So it's hard when you build these quantum computers to maintain kind of the state for a long period of time, so that you can analyze a bunch of problems and not kind of have the whole thing kind of stop and then have to restart. And so it's better suited at the moment to solve really complex math problems, for example. But it is not well suited to do the kinds of analysis that you might do today, or that you will do today with a Blackwell chip from Nvidia, where you're looking at multiple different data sets at the same time and like trying to aggregate a bunch of different data sources and come up with some meaningful insights right now. And so it's the future. You could think of quantum as, hey, this is going to be a disruptive technology. It's sort of like it's infinitely more powerful than what you can do in a classical computing framework, but it's not ready for prime time yet. And so,
but then why did the stocks rip in the last 2 months? And when I say rip, like went up 1,000% in 2 months.
Yeah, well, so there are only a handful of quantum stocks that trade today, and a lot of them went public in the heyday of 2021. Many of them through kind of SPACs and de-SPACs, and so
those are the special purpose vehicles that just like kind of have cash, and then instead of doing a proper IPO, a company can kind of like do an M&A transaction to become a publicly traded company. It skips a bunch of IPO processes.
Right.
Yeah.
Or in Canada, like, it's more closer to like kind of backdoor, or taking over a shell company that's already existed, and you just sort of cut right to being a public company. And typically those are companies that had been, at least in Canada, like lower quality. And people argued that wouldn't be the case when it became popular in the US. As it turns out, at the tail end of a bull market, it did get a lot of companies that probably shouldn't have been public. So these quantum companies came out, many of them like Rigetti, for example, which we'll talk about later, $10 a share. And in the summer, you could buy Rigetti's shares for like 50 cents a share, 60 cents a share, something like that. So they did rip, but they ripped after being absolutely murdered over these last couple of years. Why did they start ripping? The first thing was Trump got elected. And so people started to say, I think, and China had come out in October with sort of a cryptic news story that they had used their own quantum computer that they developed to hack into RSA level security of some financial institution or something, and get access to a bunch of data using their quantum computer. And so when Trump was elected, everyone was talking about Trump trades and what should I get into because Trump's being elected and all this. And I think quantum got swept up in that because the thinking was, well, is Trump just going to sit back and let China kind of, rule the roost with their own quantum computers? And these things really started to move like crazy. And then in second week of December, Google kind of surprised everybody and sort of came out with this announcement that they had developed their own quantum chip called Willow. And it had some, it consisted of 100 qubits. That's how we measure qubits, not bits. And they were able to solve like this very difficult math problem in 5 minutes that using today's classical, supercomputers would take them like more than the history of time, to solve. And so I think it just shocked people. And people had been thinking quantum, there's all, it's sort of, it's going to be disruptive down the road, but it's probably 10 years down the road, 20 years down the road. And then the Google announcement made people say, well, maybe it's next year. Maybe things are moving faster than we expected.
Well, and so that gets us to the mailbag portion of the show. And our first question is coming from Bruno, and it actually speaks to Nvidia's comments about quantum computing, saying that it's not around the corner, that it is, 15 years is probably too soon. 30 years is probably too far, like maybe in 20 years it becomes a thing. And when the CEO of Nvidia said this, the stocks imploded.
Right.
Their rally was cut in half on a single day. You were invested in some of these stocks. I mean, how shocking is that to you? What do you do in that environment? And is Wang right? Is Nvidia CEO right?
So I wasn't as shocked, even though some of these stocks dropped 40, 50% in one day, because having bought some of these names like in early December, it was not uncommon to see these things move up and down 35% in a given day. So 50% was like, oh, okay, well, it's a little bit more extreme, but these things just are extremely volatile. And I think it's because they are extremely still early and small cap. So I think you have to take a long-term view with these stocks. I'm very bullish on the sector. To me, there's no question that this is where the computing world is heading. We'll leave aside Jensen's comments for now. I'll come back to that. But this is where the world's heading. So even if you say, okay, maybe there's a sliver of truth to what he's saying, maybe it's 10 years away. Okay, I look at investing in these stocks today similar to investing in Bitcoin in like 2013.
Wow,
and so
very early.
So I saw this clip the other day, it came across my screen from Bloomberg, where they were sitting around the desk and talking about how Bitcoin had just had a complete sell-off because it sold off from $200 to $140. It's like so much money had been lost. And relative to where we are today, obviously, like we would all have loved to jump in at $200. I think it's a question of what's your time horizon here for owning these stocks, and how much of your portfolio do you want to put into something like this? Maybe you should only be thinking of putting in 2% of your kind of portfolio into these names, and just set it and forget it, and come back to it later. But I think now's the time to buy these names when they're trading at, in some cases, $1-2 billion market cap. In other cases, like a few $100 million market cap, when they have such an enormous opportunity ahead of them. Obviously, some will succeed, some will fail. It's not a sure thing. But I think you really want to be thinking about gaining exposure to the space.
Okay, now spoiler alert, some of these quantum stocks are going to be your pro picks, so we're not going to name names right now. But, and you mentioned this, let's talk about the tension between Nvidia and quantum computing. That was kind of the heart of Bruno's question, is does not the speed at which the technology advances suggest that Wang may be protecting GPU chips instead? Is quantum computing disruptive to Nvidia?
It is. And that's why I take what Jensen's saying with the huge grain of salt. And I do not believe that we are 15, 20, 30 years away from quantum.
How far are we away? And like some quantum is happening. Like some of these businesses already have revenue.
Right.
But how far are we?
A lot of these companies, like their revenue is paltry. Mm-hmm. So I don't want to talk about, the price to sales multiple is crazy.
That was my next point.
EBITDA, okay, sorry. Like this is like investing in biotech stocks or something. Okay. You have to sort of make a bet on is quantum computing going to be successful or not? There are lots of applications that are being used today. I think when I listen to politicians, like there's always a hidden message, right? When someone says, "Oh, I'm not doing it for this," that they're doing it for, there's probably some other reason that they're doing it for. And I think you got to kind of read through Jensen's words in the same way. This is a disruptive threat. Quantum is a disruptive threat for Nvidia. It's not going to, that they're going to make billions of dollars this year, next year, the next 5 years, because they have the best chips on the market to solve really complex problems. I think when you read through like his text or listen to the clip from CES where he was talking about this, he was talking about like, when's quantum going to do the really complex, multi-feature or multivariate analysis that you can do with NVIDIA chips today? I think that's going to be the last kind of types of applications that quantum can solve. The first are going to be these more kind of mathematical problems, but those problems have a huge, profit potential attached to them. The biggest thing is the security issue that I mentioned, like with the Chinese supercomputer or quantum computer breaking into RSA level security. Any bank, any government, obviously protects its data, and RSA is considered kind of the gold standard today. if you can hack into that using a quantum computer, which we're now basically we're there, it's not 1 year away even, then you have to be thinking about like, how do I protect all that data? So the other place where this is relevant is with Bitcoin itself, because Satoshi, when he came up with the whole concept behind Bitcoin, he had something called SHA-256, which was sort of like the complex algorithm that made it very next to impossible to conceive of hacking into Bitcoin, and therefore the ledger that everyone talks about, and what transactions took place had this level of security that we kind of never seen before, and we thought was would be impossible to hack. Quantum, and thinking of a post-quantum world where you have these quantum computers out there, potentially opens that up to.
So should you be nervous if you're holding Bitcoin that it can be hacked, or?
Well, I think you should be thinking about it, and so every kind of risk is also an opportunity. So the stocks. So the reason why I'm interested in this space is that sort of there's two ways to play it. I see it. One is you're going to have companies that try to come up with their own type of Google Willow chips to kind of be the leading American quantum computer out there. And then you're going to have security companies that are basically, their job is to kind of be the next level CrowdStrike in this post-quantum world to protect every crypto wallet that's out there.
I think that's another spoiler for Pro Pick. So we'll leave it there. Let's move on to our next question. This one coming from Caroline in Richmond, BC, and actually picks up on Nvidia. Should I buy, like outside of all of this, you said Nvidia is still going to make billions of dollars in AI. Should I buy Nvidia or rotate into another chip name?
I'm long Nvidia, and I don't own any other, like, aside from the quantum stuff, any other chip names. I was
not
ARM.
A Marvell.
No, not Marvell. I mean, I used to be an ARM for a while. ARM's kind of like it's been waiting for Godot with them, this thing to move, and so I've been frustrated. So here's what I would say is that what's in the last, you were asking me before about the Mag 7, and whether they'd have a bad 2025.
Yeah.
The Mag 7, they're set up to do the best of anyone in a high interest rate world. But in the last month, I think NASDAQ is down 2%, something like that. But there are some names that are down a lot more. Microsoft's, I think, down 7%. Netflix is down 9%. NVIDIA's only down 2%. So Google's actually up.
And you like that relative strength? Is that positive?
I think it sort of says that NVIDIA is still extremely well positioned. It hasn't done anything for the last 6 months. But I do think that it's, compared to like where it trades from a go forward earnings to, or a price to EV perspective, compared to like where that multiple has traded over the last 5 years, it's kind of average. So you're not paying up for like some super stretched multiple the way some people are saying that's a risk going into 2025.
Okay, so you remain long Nvidia. Question: is there a non-obvious? We got one. I don't have it made up, but we got one about like non-obvious AI plays. You got one for us in your back pocket?
It's not AMD.
Yeah.
The AMD stock's sort of been cut in half over the last year. A lot of people thought that they were going to be kind of the emergent AI chip play. I don't see another chip player out there set to dethrone Nvidia. So then the question becomes, how else do I want to play AI? Do I want to play through a hardware player like a Dell or an HPE? SMCI has obviously had a lot of problems in the last 6 months. So I think I'm not really thrilled about the idea of like trying to play the hardware vendors as a way of playing this. So then you're left with some software names or AI application players, and so you're talking about like Palantir, Salesforce, and so forth. So I think the problem with that is that Palantir is expensive, and Salesforce, you're getting a lot of other stuff in addition to just sort of their AI focus. So it's not obvious to me that there is a great sort of set of alternative AI stocks to own. And I think part of the run up just, it sort of got hypercharged after the Willow announcement is that I think, I don't think there's ever been an AI bubble in stocks. Point me to it, because I haven't seen evidence of it in Nvidia and a lot of these other names. Maybe you could say SMCI was in a bubble, on its own for a while. or Palantir is, but I just haven't seen it broadly. I think there is this potential that we could see a mega bubble in quantum. And I think it's because people are seeing these quantum names as sort of like, sort of a next gen AI way, of sort of expressing interest in where AI is going. So, but bubbles can be good, just as they can be bad. You just don't want to stick around too long with a party. So even though it hasn't been great over the last couple of weeks with these quantum names, and since Jensen's comments, I mean, Nvidia's stock also hasn't done that well since Jensen's comments too, which is kind of interesting. I think it sort of speaks to that. I think the market's sort of reading that they see an implicit threat to Nvidia from quantum.
So are you more excited about quantum than you are about AI right now? Like, we haven't even seen the full deployment of AI. How can you be moving on already?
Show me the stocks that I could, put my money into for this AI, turnout. And the problem with, I guess, even though I'm long Nvidia, the problem with Nvidia is it's so darn big already. It's massive scale. And I think that's been part of the reason why the market really hasn't, fully, bid it up in some sort of bubble-licious area. Because I think they believe that, wow, these numbers are so massive. How do you, on top of the numbers they're doing this year, see 20% growth next year and the year after and so forth? You're really getting big.
Let's bring in our next question. This one's from Tom in Toronto. It's about crypto. What's the best crypto investment in the stock market? And what are your thoughts on MicroStrategy?
I would say MicroStrategy is probably the best, my best idea for how to play it.
You're not nervous about them issuing debt to buy more Bitcoin, like in that circle that they're caught in?
No, I don't see it as a Ponzi scheme, which is, some people have said. I mean, you have to believe that the price of Bitcoin is going to be higher a year from now.
Do you?
I do. Yeah. I think it's probable that, we're going to be in, ending 2025 with like 200K Bitcoin. So
why not? So you prefer to do MicroStrategy. Would you just own Bitcoin? Like, why not own just Bitcoin if that's a
because
double?
You're just going to get more, juice from your squeeze, basically. So I just think they're in a really dominant position as sort of this like major company now, even though they didn't start out that way, that has Bitcoin on its balance sheet. They've got some imitators out there, but they're the biggest. And so I just think they will increasingly over time, as you see the price of Bitcoin tick higher, not just this year, but in future years, where that is going to get reflected in the value of their own shares. So if you'd asked me like at the end of 2022, like my favorite crypto idea was Coinbase. Mm-hmm. I still think they're a great company. They're extremely well positioned. A lot of their competitors have been sort of wiped out post FTX, but they've gone from like $30 to I don't know, $240 or wherever they are today. And so it's just been a lot of appreciation. I don't see this, as Bitcoin goes up, yes, a Coinbase will go up or other names, but I just don't think like it's going to, be as great as a MicroStrategy. So that would be my biggest idea. Like in terms of a small cap name, there's a Canadian company called DeFi Technologies where
I know you love DeFi.
Well, since we talked about it last year, it's like 3-4x, Amber.
I was so skeptical about it on our interview, and boy, yes, it went up 3-4x.
Now, full disclosure, I'm an advisor to the company.
Okay.
So, take this with take that for what it's worth.
You're involved.
Yeah, and so like I guess I'm a long-term believer in it, but they're basically an ETF provider over in Europe with plans to expand to Asia. So for me, it's just a valuation play. Like you're basically, they're profitable today. They make money from these ETFs. They also make money from like, proprietary trading that they do in the crypto space. And, there's a bunch of ways they can win. They expand geographically. They just, suddenly they double and triple their market opportunity that they're selling into. Are they going to come into the US? They said they want to. Are they going to come into Canada? I mean, there hasn't been any announcements along those lines yet, but we'll see.
As I said, I didn't follow you into DeFi at my peril. I followed you, though, into Opendoor Technologies, and that one did not work out for me. We got a question from Sandeep. What is your thesis on Opendoor? What do you want to see from management? Are they doing a good job managing in this housing environment? And what are some things you're looking forward to from them in 2025? As I take a look at the stock languishing in my portfolio and on the chart down at the lowest level since 2023. Did you cut your losses or you still buy here?
I've cut my losses. I still own a bit. I am still long. It's been a hugely frustrating name. I do believe eventually it will work. But I would not give this management team high marks so far. So just stepping back, I love situations like Opendoor and Carvana, where you have an unprofitable company where the market's just kind of given up on it. And then suddenly they turn profitable. And it's a big surprise. That's usually a huge re-rating opportunity for a stock. That was my hope. Like when I got into Carvana, I also spotted, or I believed that Opendoor was also primed to do a Carvana type of recovery. It's obviously worked out really well for Carvana over the last couple of years, has not for Opendoor at all. So the biggest difference is Opendoor is about, basically bypassing sales commissions for traditional real estate agents and just doing it through a sort of like an online model. And so they are flipping houses. They're buying them, giving people cash immediately, fixing them up, trying to sell them, get them off their balance sheet. They haven't made money at it. So they got rid of their founder CEO. They brought in a Canadian woman, Carrie Wheeler, as CEO 18 months ago or something like that. The problem is with them, unlike Carvana, we've been waiting and waiting for them to kind of make that leap into profitability. They really haven't done that yet. And their sales have been sort of up and down. The good news is that the market's sort of been like wiped clean of like competition to them. They have a national platform if they ever get their act together. But like until the market sees them dependably profitable, I think they're just going to question the model. And at the same time, they are tied to the mortgage rates in the US. So with 7% mortgage rates down there, that's like whenever they go up, Opendoor's stock price crashes. So it's now mid ones. I do think there will be a day where, the sky is clear and, people will say, hey, there's value in this model. I very much believe in like the original VC behind this guy named Keith Raboy, one of the smartest kind of VCs and operators out there, but it just hasn't worked the last couple of years. Whereas Carvana, has been able to show that kind of flip to profitability.
Another one I didn't follow you into, which is Carvana, and that's up like more than 6,000% in 2 years. And again, a pandemic name left for dead, and then there was a turn. And you rode that higher. Then recently there was a short seller report, Hindenburg, basically alleging that this is like a grift between a father and son. There's a lot of financial self-dealing that's masking weak financial health. Do you still like Carvana here?
I do. I don't own it like as much as I did. I have a small kind of long position in it. I haven't gone through the whole Hindenburg report, every it's 100 pages or something like this, but I've sort of read like the major allegations. These allegations have existed around this company for, when it was like a $400 stock, pre the collapse and near death experience that I experienced in 2022. So I just, the one thing that they don't say in their report, when they sort of complain this is like a low margin model compared to its peers, is Carvana is just like a totally different model than its peers. It's even the online kind of peers that sell cars. And so they already are, and they will be, much more profitable than AutoNation, or one of these companies. So there's a reason why their kind of multiple is stronger. And this is a totally different company because they did a huge acquisition right before their stock collapse, which almost killed the company of, another company called ADESA, which is basically kind of has this whole sort of network of distribution centers that wholesale access to cars, ways of like fixing up cars nationally that cost a lot of money, but now has sort of positioned the company, much, more strongly and with a better ability now in this sort of more recent run up to be more profitable than it was before. So we kind of haven't seen a Carvana, in this iteration before with its kind of potential for profitability and national, footprint and, strong customer ratings and so forth.
Let's squeeze in one more question here. Apple, it's pulled back recently. Not quite the high flyer that we've been discussing with other stocks, but it has pulled back. It's down about 10% from its most recent peak. Would you buy the dips? This is a question from Arnie in Toronto.
Yeah, I of all the Mag 7 names, I like Apple, I like Meta, I like Tesla, I like Nvidia, those four. And Apple is just like very dependable. Obviously, it's fortress balance sheet. We talked about there's the potential we could be in this sort of higher for longer kind of interest rate regime. Nobody's better positioned to deal with that than Apple. We all just continue to pay up for, a restocking every year of kind of new devices for our families, services and so forth. And people are willing to pay a higher multiple for it.
The bearish argument is that it is too expensive for a slow growing company. iPhone sales seem kind of sluggish depending on, what metric you're looking at, and that where are they on AI deployment? It seems like it should be easy for them.
My kids love Apple Intelligence. And so I think this is now something that's sort of been forgotten about, like as an AI, component of the Apple story. But they just kind of keep iterating and rolling out new features. We get, kids love talking to Siri. And that's the main interface for this Apple Intelligence. The integration with ChatGPT is kind of interesting too, and how and where they go with that is going to be interesting to follow. So I think that's still going to prove to, as in the next few weeks, we're going to see their holiday sales. We're going to see whether the 16 is a dud, as sort of was the conclusion, like right after the announcement last fall. I think it's going to surprise to the upside, and I think that's going to be supportive for the stock.
Okay, so that is it for the mailbag. Now we're going to get into the pro picks, which is the top 3 best investment ideas that Eric has. And this segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB Capital Markets Arm is a full-service investment dealer. It offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick is BTQ Technology. So in quantum computing, looks like a smaller market cap company. And is the CEO the same CEO of DeFi Technologies?
Yes.
Okay, so sneaky way to get the DeFi connection in. What do you like about BTQ?
So remember I said before, there's going to be quantum folks building the computers themselves, and then there's going to be the security plays. This is the security play. So their BTQ stands for Bitcoin Quantum. So the founder of DeFi was also the founder of Hive, which is a sort of a Bitcoin miner, from 2015-16. And I first heard about it because he was telling me like his first vision for BTQ was that when he developed his own crypto wallet, he started hearing about this long-term potential threat of quantum computing. And he thought, wow, like a lot of people are going to have to pay attention to this, maybe not next year or 5 years from now, but eventually. But this space kind of, you have to make the investments today. So they've been working on this area of post-quantum cryptographic, protection of crypto wallets and other RSA level security for over 10 years now. And it's really one of the only ways of playing a public stock that has focus on this space.
So it's 10x'd in like a month, 2 months. It's also had a drawdown, as a result of the Nvidia CEO comment. Where is this on the risk meter? Like you're not allocating like 10% of your portfolio to this. Like how prepared should investors be, A, for big drawdowns, and B, like how far away is this future?
Well, like all of these quantum names are announcing customer deployments today, and I expect,
and BTQ has customers,
and I expect they're going to have some kind of big name customers announced this year. They already have a bunch of hardware partnerships. They've worked with Foxcons of the world and Honhai and different hardware providers on different types of solutions. To this point, hasn't been a meaningful amount of revenue, but what's the potential here? I mean, this is a stock that's trading a few $100 million market cap today, even after this sort of 10x run up. A CrowdStrike trades at like an $80 billion market cap. Now, they're not going to be an $80 billion company tomorrow, but this is an area post-quantum security where like a Palo Alto or a CrowdStrike can't just sort of snap their fingers and have a product out there in the market tomorrow. They're going to.
So would they just buy a BTQ?
They could, yeah.
Yeah.
And so that's definitely something that could happen. But I never want to buy and own a company for that reason. So I love the fact that this is kind of like, I see this as almost like a venture investment. And most of the time, public stock investors like me or others, they don't get a chance to kind of really buy in at a kind of very low market cap. Like a Rigetti, which we might talk about later, is like, a 2 billion. So BTQ would have to 10x from here to match Rigetti's market cap. And there's still the potential for all of these quantum names beyond that. So for me, I think this is a kind of name that you want to put in your TFSA or your kid's RSP, tuck it away. I think it's going to have, some meaningful appreciation in 2025, but certainly 2 years from now, 3 years from now, I think it's going to be, multiples larger than, a few $100 million market cap. So that's why I like it. And that has nothing to do with interest rates and the economy. And even if there was some sort of like 2022 type pullback, these names, I think are going to have growth stories of their own that are completely orthogonal to all this kind of macro stuff that we usually get bogged down in talking about.
Okay, so that brings us to Rigetti, which is your second pick. This one fell 55% in the course of a couple of days. And yes, it's been huge. But, I know you look at momentum. This is like, a hot knife through butter. Why get in front of a name that has been just like slashed like that? Is that a risk? How do you view it as a buying opportunity, if not a risk?
I look at the Jensen comments as sort of like it's cast a cloud over the whole sector for probably, a 2-week period. And then there'll be some other announcement, some new announcement, some updated, version of, that somebody ships of a new quantum threat or something. I just think at a $2 billion market cap here, where, post sell-off, I just think there's, a bunch of like the risk reward is now suddenly way skewed to the upside from here.
Now, I know you don't want to talk about this, but yes, it's a $2.5 billion market cap company on a company that has 11 million in revenue. Why isn't that a problem?
Well, their competitors, with their systems are Google, IBM. Both of these companies, like obviously huge mega cap companies, have teams of people working in this area. And Google has shown an ability to actually ship something. But typically these larger companies don't. And so I like the idea of like putting some investment dollars behind a more entrepreneurial name that's sort of, that's all they have. They have to live and die by what they do. They don't depend on search or anything like that. I also know Spencer Rascoff is like former kind of CEO of Zillow. He orchestrated the whole SPAC and de-SPAC of Rigetti, back in 2021 or whatever it was. I know a bunch of people who were investors in the original, de-SPACing. So I just believe in the company long term. There's actually a Canadian founder, Chad Rigetti, who's no longer with the company, who was the one who started this company originally. So I just think there are a lot of things that can go right here. And probably the first thing that's going to happen is Trump, assuming the presidency, and what happens when we get the first announcements of a pro-quantum crypto strategy that Trump is getting behind.
You said that, well, at least with the previous one, BTQ, it's like immune to interest rates. But is it really? If we're talking about a high interest rate environment, doesn't that knock on these profitless tech companies, like the most speculative kind?
These are the most speculative. I mean, this is even more speculative than like a biotech or something. But like you have to believe that quantum is going to be successful for the long term to kind of put some of your money behind some of these names. But assuming that they will be, like, you're not waiting for some phase 1 trial to be completed, phase 2, phase 3, like a biotech name. Like in some ways, the fact that they are so speculative, and there's such this long runway ahead of them, so that gives me comfort. Again, like it's similar to this sort of Bitcoin 2013 type of analogy time frame, where I just think your upside is so much greater if assuming that you don't have to kind of use this cash immediately for the next 1, 2, 3 years.
Okay, your third one, I feel like we have a good sense of who you are right now. So the third one seems like it's right in your wheelhouse. It's Peloton. And your specialty seems to be finding names that are left for dead and waiting for that turnaround. So Peloton is down 95% since the pandemic. But in the last 6 months, it has surged 140%. Is this the turning point?
I think so. I think this is going to turn around faster than Opendoor for sure. They are already profitable. They've shown that over the last few quarters. They have a new CEO that just started last week, who took over for Barry McCarthy, who's sort of leaving, who was people thought was going to be the turnaround architect. So this is a value opportunity. Like there's a lot of admin costs, marketing costs. Has anyone seen a Peloton store in the malls recently? Like actually before the holidays was the first time I ever saw a customer in any of these stores. This new CEO who used to run Apple Fitness Plus, I think has ample opportunities to cut costs. And then they've got this core group of loyal subscribers who are going to keep paying up for this service. So not a lot has to happen for them to become much more profitable this year. And a little bit of growth, which is what Carvana saw, not a huge amount of growth, a little bit of growth. Suddenly this becomes like a massive turnaround opportunity.
Stock's at $8.50 and change right now, $8.50. Where does it go?
If everything goes right this year, this could be a $30 to $40 stock in 12 months.
Eric, that's all the time that we have today, but thank you so much for being our first guest. Most of it went off without a hitch, wouldn't you say?
Yeah.
So as a thank you, we've got a little swag that we're giving away. And this one I think like really speaks to who you are. So why don't you pull it out?
Oh,
there you go. You got the rocket.
The rocket man.
The rocket man emoji. I think it's very fitting to the kind of
and whenever I think of you, Amber, I think of color. So thank you and the In the Money team, and congrats on the launch today. It was a thrill to be here with your maiden voyage.
Thank you so much. We appreciate it. And thank you everybody for joining us. This is our very first episode. There's going to be more. In fact, on Thursday, we've got Rick Rule. He's the president and CEO of Rule Investment Media, and he's going to be taking your questions on all things gold and resources. You can get your questions on at In the Money Pod everywhere on social media, or you can email questions@inthemoneypod.com. Thanks so much for watching. We'll catch you on Thursday.